Welcome back to our grand finale explainer. Throughout our journey with the 151 Trading Strategies Encyclopedia, we've explored an incredible array of theoretical mathematics and complex quantitative concepts. But today, we're doing something a bit different. We are bridging the app. We're taking all of that theory and exploring the practical R-code scaffolding from Appendix A that makes algorithmic trading truly actionable. It is literally the multi-million-dollar question, right? We have the math. We have the strategies, but how do we know they won't just bankrupt us in the real world? Because without a rigorous reality check, even the most brilliant trading strategies are just fairy tales waiting to lose money. Today, we are looking at the mechanical realization of that reality check. Here's our game plan for this explainer. 1. The reality of backtesting. 2. The main function engine. 3. Structuring and adjusting data. 4. Modeling real trading costs. And 5. From math to execution. Section 1. The reality of backtesting, the ultimate BS tester. The authors establish an absolute, non-negotiable rule right out of the gate. All strategies in the encyclopedia must be backtested out of sample before being trusted. Listen, no amount of historical correlation or brilliant math matters if it can't survive a real-world, forward-facing test. It's that simple. So what does out of sample actually mean? It is the process of testing a strategy using only historical data that was strictly available prior to your simulated trading time. You absolutely cannot peek into the future. Running an in-sample backtest where your expected returns are somehow influenced by tomorrow's closing prices is a massive, deceptive trap. It is future-gazing, and honestly, it will destroy your capital. Section 2. The main function engine. Cracking open qrm.backtest. What's really fascinating about this specific code scope is that the scaffolding is designed for purely intraday strategies. That means positions are established right at the market open, and they are completely liquidated at the close of that exact same day. Boom, you've got zero overnight holding risk in the mechanics we're about to explore. Let's dive into the engine itself. The qrm backtest function takes 7 critical arguments. You've got days, which sets your lookback window, and ddar, which handles the moving window length for recomputing your risk model. Then we have the volume checks. d.adv looks back at average daily dollar volume, which directly determines n.adv, the top liquid tickers making up your universe. Finally, inval level dictates your total investment, BNDS controls your position sizing limits, and include cost is just a simple Boolean toggle to flip trading costs on or off. Section 3. Structuring and adjusting data, ingesting the real world. To run smoothly, the code requires 5 precise tab-delimited files in an R-ready format. Picture this. Your tickers descend straight down column 1, and your dates run right across row 1 in descending order. You need your overnight close-to-open returns, raw open prices, raw close prices, raw volume, and your fully adjusted close prices. Alignment is everything here. All 5 files absolutely must feature the exact same tickers in the exact same order. This allows the code to cleanly calculate log returns precisely from the adjusted open and close. And this setup brilliantly dodges a massive pitfall in quantitative trading: corporate actions. Think about it. If you trade on raw open prices, a simple 2-for-1 stock split is going to look like the stock just lost half its value overnight, completely ruining your backtest. So, the code uses a really ingenious mathematical adjustment factor. It takes the ratio of the fully adjusted close to the raw close and applies that exact same factor to the raw open. This effectively forces the open price to respect splits and dividends consistently, keeping all your data totally pristine. Section 4. Modeling real trading costs, the reality filter. 10 basis points. That is the target average cost scale used in the code. The cost per stock dynamically scales based on historical volatility and daily volume, utilizing an overall mathematical scale factor, zeta, that is universally anchored right to this 10 basis points reality check. It sets a conservative, linear cost hurdle that every single strategy has to clear. But this presents a real practical dilemma. When quants try to perfectly optimize expected returns while subtracting dense, dynamic transaction costs across thousands of stocks, well, the math gets incredibly heavy. Full nonlinear cost optimization can slow a backtest to an absolute crawl. So how does this R code get around that? It uses something we can call the effective return hack. Think of trading costs like a toll booth. The code simply subtracts the estimated cost from the expected return of a specific stock. If the expected return isn't high enough to literally pay the toll, it gets instantly zeroed out. Gone.
Only the stocks with an effective return greater than 0 are allowed to pass through to the mean variance portfolio optimizer. It's such an elegant heuristic that saves massive computational power while instantly eliminating unprofitable trades.
Section 5. From Math to Execution, the Grand Synthesis. Before we synthesize, we have to note a vital warning from the source material regarding survivorship bias. Because our code establishes and liquidates on the exact same day, survivorship bias isn't fatal. But if you take the scaffolding and adapt it to hold positions longer than a single day, you absolutely must include data for tickers that have gone bankrupt or been acquired. Testing only on stocks that survived until today paints a falsely rosy picture of the past. Don't fall for it. All right, here is the ultimate takeaway. This 5-step universal scaffolding is the beating heart of the entire encyclopedia. Whether you're trading the covered calls we explored in earlier episodes or deploying those intense crypto neural networks, at backtesting time, every single strategy reduces to this exact workflow. You define your universe and risk, calculate your expected returns, deduct your costs, run the optimizer to find your weights, and execute it walk forward day by day. We're talking about over 150 pages of dense theoretical mathematics, over 150 complex quantitative strategies, and it all culminates in this one executable function call. This is the moment where the theory finally leaves the whiteboard and becomes purely actionable in the market. And that brings us to the end of our journey through this source material. You now understand not just the what, but the how. You literally possess the mechanical scaffolding to build and backtest real quantitative models. The tools are in your hands. So, the only question left is, what strategy are you going to code into reality first?